Welcome back to A Bite from the Money Sandwich, where we provide practical and easy to understand tips and ideas on how to manage your money better, so as to let you retire with comfort and on your own terms. Want to know how to make the smartest moves in property investing? Today, I'm joined by Damian Collins, who is founder and managing director of Momentum Wealth, also chairman of Westbridge Funds Management, and the author of his new book, Property Investing Roadmap. Damian talks all things property investing, including the key strategies, which he covers off in his new book as well. We discuss the importance on educating yourself if you're wanting to invest and explore the pros and cons of residential versus commercial properties. Damian and I also highlight the benefits of diversification, understanding property cycles, and seeking expert advice. If you're interested in property investing, this episode is for you. Well, thank you, Damian, for being on the show. And you've got this new book, Property Investing Roadmap.
Yeah, good to be here, Mark. And it was great to launch the book. Pretty exciting. Took a long time, a lot of work, but certainly really proud of the outcome.
Yeah, and from someone who's gone through that same struggle and challenge of writing a book, it really is something that you can be something very proud of. But geez, it takes a lot more work than you think, doesn't it?
Absolutely. It's not just writing the words down. It's all the other stuff that comes with it, covers, you don't even think about all that sort of thing. And luckily I had a great team who helped me out. But look, it's really exciting. It's something I've been meaning to do for a long time. But about a year ago, I knuckled down and started to put it together because, I love property. I've been in property for a long time, over 30 years. So and a few people have said over the years, I should put something down in a book, and finally did, and feedback so far has been great.
Excellent. And yes, I remember even things like future tenses and past tenses and present tense and sort of thing, and you do that all in one paragraph. So it can be a little bit. So I'm glad you had a good team behind you, and you got this great book out. One of the things is, and in the same in my career, more of the financial advice, you help a lot of people one-on-one, but a book can actually reach out to much more, just a larger group of people, a larger crowd. What was sort of for you some of the key inspirations in writing this book?
Well, it's exactly what you said there, Mark. It was the fact that, look, obviously we've got a business that helps people in property investing right from the first investor through to sophisticated property strategies, but it's getting out there for people who maybe like clients who live in another part of the country and so they can understand our investment philosophy and the way we go about things. And so and really, and that was the purpose of the book. Fundamentally, the first part of it was all about understanding property, what makes a good property investment, what doesn't, and not falling for all the traps that a lot of people fall into. And then the second part was really about, well, not just buying one property, how do you build a large portfolio, and how do you live on that income for retirement? And that's critical because a lot of people buy residential property and then they get to retirement and they go, well, it's not giving me much income, and it doesn't. In Australia, you don't get a lot of net income from a residential property, so they end up selling it and they're exiting the market altogether. Whereas our philosophy on it is you start with residential, then you get into commercial property. Commercial gives you a much better yield and returns, and a balanced portfolio means if you set it up right, you don't have to sell it all off. You can get an income stream, and obviously depending on how much property you're in, you might well set yourself up for an income for life.
Yeah, and you've covered off a lot of points there, so we'll go through those one by one. But I think right from the beginning, you were sort of saying, people coming in, seeing you one-on-one, there's a real education you need to do for people, and having this book sort of say, well, basically, read this book first, get the education, so at least you come in equipped, you understand property, you've got the right questions, because it really is so important. There are just so many pitfalls in the property, and it's not, same in my industry or my profession. The education is just such an important part of it.
I think that's critical, whether you're investing in shares, property, whatever that is. I think it's critical that the client has an understanding of why you're recommending certain things, why you think this is a good investment property, or the same would apply. I'm certain in shares and financial planning, why you should be allocating your assets to this particular area. So absolutely, great education piece is critical. So, because it's end of the day, it's the client's money. You're relying on advisors, of course, to help them. But my philosophy is that you always want to have a decent understanding. Obviously, you leave it to the experts to get down to the fine detail, but have a decent understanding of what you're buying, what you're investing in, because ultimately it's your money. And and you should get as much education as you possibly can.
Yeah, and you talked also about difference between, or balanced portfolio between commercial and residential. But just for the person who just sort of comes in, and we're going to talk about building income streams and why that's so important for future financial security and freedom. But for the person who is just coming in straight away, why should they invest in property compared to shares? And I know there's talking about diversified portfolios and having a bit of each, but I've talked to plenty about super and shares. Why property?
Well, property is an asset class that's it's obviously been around for a long time, and historically, particularly residential, it's been a very solid performer across Australia. And fundamentally, that's driven by population growth and the strengths of the economy. They're the two critical factors that have helped drive property prices. I know my parents got their first house. It was $12,000 back in the 1970s, and of course now they're in Melbourne, and of course now the median price is pushing up to close to $1 million. So it's over the long term. Property should definitely be, I think, part of an investor's portfolio. How much that is obviously up to the individual and their advisors. Obviously, I'm pretty keen on property. That's my background after I left accounting and my profession. But property, it's also from a volatility point of view. You just don't historically see property prices collapse, and in particular residential. Commercial is more volatile, but residential property, as we've seen through the cycle, a down cycle is maybe 8 to 10%, and that doesn't happen all that often. We saw a down cycle a couple of years ago when COVID hit. We saw a down cycle in Sydney and Melbourne about 8 to 10%. That's about the worst it actually gets, and it often goes in a different stock correlated to the stock market. Often they go in different cycles. So just from a diversification point of view, it makes sense. Also from a historical point of view, obviously the future can't be guaranteed, but historically it's performed solidly and a little bit above inflation. That helps hedge your portfolio, continues to grow, and you can certainly, particularly if you add some commercial to the mix, you can get a solid income stream that could set you up and for life and give you that income that you want in retirement without having to sell off all your assets.
And you started that by saying, comparing to what your parents paid for property to what you're paying now. And I think that's why getting really good expert advice is so important, because to me, the rules have changed. Someone could buy a property last century for 2 or 3 times salary. Now it's getting closer to 10 times salary. And I do worry about a lot of young people getting into $1 million of debt or 1 point, even more. And, that was fine when interest rates are 2 or 3%, but when it goes to 6%, so getting really good advice is so important. Do you see, and when you're sort of saying about when you do get advice, and some of the things you talk about is that property having diversifying between residential and commercial. So that's probably, I'm not quite sure. I must admit, I've got a history of using property, buying both. But I basically fell into commercial property rather than that was something I planned for. So can you give me a bit more, what are the pros and cons of both residential compared to commercial property?
My residential is, and that's where most of Australian investors gravitate to. And I understand why. It's something they know and understand. They've generally obviously got their own home, and they like residential property. And residential property is one of those assets where even in a bad market, you generally could still get a tenant. You might have to drop your rent, but if you're in the major capital cities, you're generally, even a bad vacancy market in residential is only 6 or 7%, and so generally you can still get a tenant, albeit it might take a little bit of time. So from an income point of view, there's some stability of income. You're not likely to sit in a residential property vacant for 12, 18 months, which you can do on the commercial side. We touched on earlier about how historically it's been a steady hedge against inflation, has outperformed inflation by a little bit each year, and that's a good investment for most people. You're not going to get rich overnight, but in the long run, you can certainly make some really solid returns. And the other thing is that's really good about residential is the ease of financing. Obviously, with rates a bit higher now, it's not as easy to service a loan. But one good thing about residential is once you get the loan, if you can service it, you'll never hear from your bank again. They don't do revaluations. They don't call in the loan. Different to commercial property. As long as you're making the payments, you won't hear from the bank to reassess your loan for the 30 years. So and the leverage you get can be as high as 90-95% if that's what you want to do. So much easier to start. And that our philosophy is, and Residential is a great place to start for all those reasons I mentioned. Plus, with our tax system, like it or loathe it, I know a lot of people loathe it, but the fact is negative gearing helps you make the payments. So you're still losing money. So that's why it's critical if you are negatively gearing, you're getting capital growth, because without that strategy, you're going backwards. You're losing money each year. Yes, you'll get some back on your tax. So all those things together will make residential a great place to start, but it does have some downsides. And the biggest downside is the fact that it's the income stream in Australia, because we've been able to negatively gear. A lot of investors will take very low yields, so they're very happy to buy an asset. And across Australia right now, Mark, I can buy assets in Perth and Adelaide around the 5% yield mark, Brisbane a little bit less, and then you get to Sydney and Melbourne, you're talking about gross yields of 3.5%, maybe 4% if you're lucky. And then by the time you take all the other things on top of that, now Victoria's slugged around with an extra land tax on your home, on your investment property, I should say, right down to 50,000 of land base. All of a sudden, you're taking up those costs. You're netting probably 3% in Perth, Adelaide, 2.75 in Brisbane, and Sydney, Melbourne. You're pretty lucky to net. So if you got 2% net, you'd be doing well. And so that's not a really solid income to retire on. If you've got $1 million of property and you're getting 20 grand a year, and you're not going to get a pension if you've got $1 million of assets. It's simply not enough, and that's why we do like commercial property. Commercial property's got a much better income stream. 6%. We just bought some assets, say 6.6% for 25 million in one of our funds. So you certainly get a much better income stream. The tenant pays the outgoings. So from that point of view, it's certainly a better cash flow asset and helps you in retirement. It does have downsides though. To get into good quality commercial property, you're not going to get much for $500,000, and even $1 million is you're still going to get pretty second rate sort of stuff. You really need to be going up the price for chain. The other thing to be aware of in commercial property is that the vacancy risk is high. So in a residential property, you might go vacant. Generally, you'll get a tenant if you drop your rent. Sometimes in commercial, it can sit there and sit down. If you go into the CBD in Sydney or Melbourne at the moment, look at some of those B-grade office towers. They're sitting vacant, and they'll still be vacant in 3 years. So you wouldn't want to be owning one of those ones. So to get in directly into a commercial property, it's very concentrated. So for an average person, one single property, and if they've spent $1 or $2 million, and that's a big chunk of their portfolio. So there are ways around it. We might get a chance to talk about that today, to go through into funds, into property funds. That's one way you can get access to good quality commercial assets by buying into property funds, whether they be listed ones or unlisted ones. But commercial property, if you can get it right, certainly as part of a balanced portfolio, is going to give you much better income stream in retirement, which is exactly what people are looking for.
And people, a lot of people may not realize that's one of the things you can do when you have a self-managed super fund. You can have property under there, and actually commercial properties has that loophole that actually can be transferred over into your self-managed super fund, whereas residential property, you have to sell it, put the cash in, and then buy a property again. So there are definitely pros and cons for both. But I really do like, as one alternative, if you don't actually have the funds for commercial property, that you can do through funds, and we will touch on that. But let's just get back to, if you wouldn't mind, getting started. And I'm sure that's what a big part of your book is about. I'm someone who, exactly as you said, I'm in Sydney, and I'm actually happy to pay the rent I am, because I'm only paying probably 2 or 3%. And if I want to, but I can afford an investment property, 6, 7, 800,000, and get 4, 5, 6% return on that, I don't really care where it is. It doesn't need to be in the same suburb I'm living here in Sydney. It could be in Queensland, it could be in Adelaide, it could be in Perth, as long as it's got good growth and, as you said, a good rental income, which eventually, hopefully, you will live off, or at least in the beginning, it helps pay the loan.
Yeah, absolutely. And a lot of people do that. It's becoming more common where people rent in the suburb they like and go and buy an investment property elsewhere. And I think if you are going to get into residential property investment, you certainly want to be thinking outside just your own hometown and even your own suburb. So many people will buy an investment property within a couple of kilometres of where they live, just because they know it and they know that area. If you are going to buy an investment property, you've got to do a lot of research, because that small percentage growth, and that obviously applies to shares or to real estate, just a couple of % additional growth each year over the long run is hundreds of thousands. It could even be millions over a 30-year period. So it's really about understanding the fundamental demand and supply. So you want to look in cities that have got population growth, more people helps push more demand for properties, and strong economies, because higher income means people can pay more for rents and pay more for properties. But critically, within those cities, sticking to locations. We like to target areas across the country that are gentrifying. So they're in early phases of rejuvenation. So what you might look at your Glebes and those sort of areas in Sydney that might have 35, 40 years ago might have been that flash where they've gentrified over that period of time. They're near city locations. Same in Melbourne. Richmond is a location that I remember growing up in Melbourne was pretty much the pits. And I wanted to live in Richmond in Melbourne, and now it's super popular because it had all the right things going for it. People with higher income started moving in, renovating, refurbishing, and that's where you get that outperformance and that extra 1 or 2% capital growth. And over that long period, adds up substantial amounts of money. So yeah, I think as a residential property investor, don't just look in your own hometown. Don't just look in your own backyard. You've got to be prepared to look look more broadly across the country, because you don't have to go and visit it every day. You've got a property manager, and they'll keep an eye on it for you, and they won't drive past it every day, but they'll look after the property for you. And so it's got to be about investment with your head, not your heart.
Yeah, and I think that's a really, really good point. A couple of really good points, actually, the gentrifying and the with your brain, not your heart, because I do see so many people who get mistakes, who fall into traps of buying an investment property, and they think, well, I've got to be close to where it is because I want to be able to see it do that. Well, you don't need to see it at all. As long as it's growing for you, and as long as it's getting a good rental income, you don't really care at all. As long as it's being looked after, as you said, by a property manager. And I think those sort of tips you're giving, I'm sure that's what's in your book, but that's also why you go get advice. And I find a lot of people about these self-help books, it is great to get you that education, but you realize there is just so much you just don't know. We're not following the cycles of a migration and all these sort of things that you're doing. And even as you said, the gentrifying, these are sort of things that you do every day and the average person just doesn't.
Yeah, that's right, Mark. And certainly it's the same in any asset class. There's experts in those fields, and property is one of those areas where I think historically a lot of people have just gone out and thought, well, I can buy anything. I think those days are over. You mentioned earlier about the great price growth we've seen, but how expensive relative to our incomes property is. So we're just not going to see properties growing at 8% per annum anymore when inflation is 2 to 3%, and incomes growth is 3 to 4%. 8% is unrealistic. I'd say, well, could we grow 4 or 5%? Yes, we could. But then you might find a couple of areas and a couple of suburbs do go a little bit better, and that's what you're looking for. You're looking for the diamonds in each of those cities and suburbs, because we want to eke out that little bit of capital growth. It's certainly no longer a market, in my opinion, in Australia where you can just buy anything and in 30 years you'll be super rich. You will certainly probably make some money on it, but if you want to really make substantial amounts from property, it's really about a picker's market now. You've got to dive right into it and use those experts, there's buyers agents who know those markets, know what the good areas are. Go and talk to them, because if you get it wrong, it could cost you a lot of money and set your retirement goals back potentially 5 or 10 years.
Yes, and we're talking about retirement, but it is actually, that's also something that's changed from last century to this century when I talk about that if you want financial security, you want financial freedom, and there's something you talk about through the book. It's not about I'm building a portfolio so that by the time I'm 65, I will have enough money through my super, through property and all those sort of things. People don't want to look that far. If you're in your 20s or 30s, you don't want to wait 30, 40 years for financial security, especially we're seeing with the high cost of living. People want that sooner, and I can understand that. So I think buying an investment property isn't that was just something the rich people did in the last century. Now it's got to be part of a plan that you're buying, looking 1 property, 2 properties, maybe even 3 properties, and building a portfolio. And that should be, if you really want to build financial freedom, that's the standard, not something just the rich do.
Yeah, I think, and that's the great thing, albeit it is a lot more expensive to buy a property now. But if you don't have to buy in Sydney, you don't have to buy in Melbourne or other locations around the country where you can get into an investment property for around 400,000, 500,000. They're still available in good locations, and the cost out of your pocket may not be that significant. But like any investment, I was talking about it in the book, you've got to be prepared to make a sacrifice. If it was that easy, everyone would be doing it. But there are plenty of middle class people and people on average incomes who are doing it. There will be a little bit of sacrifice to start. You've got to get a deposit. Maybe that's equity in your home, or you've got to save a bit of a deposit for residential. And yes, you'll probably have negative cash flow for at least the first couple of years. But it is setting yourself up for the future. And I can certainly tell you now, based on the clients that we've got, and I see those who took the steps 10, 20, 30 years ago, where they're sitting now versus someone who didn't do anything. They're going to be a lot more comfortable in retirement. They're going to be able to live those dreams they want, go around the world, spend money. And if someone else who hasn't done that, it's never too late, but the longer you leave it, the harder it becomes to build substantial wealth through any investment class.
And it shouldn't take, it is, as you said, hard, but it shouldn't take all your time. It's not, I see too many ads on Facebook and all this sort of saying, we'll help you buy a property every year. You'll have 10 properties in 10 years, but you're basically just building yourself a second job, full-time job there. So buying property is important, but you shouldn't be doing it that, and that's just crazy, isn't it?
Yeah, I think 10 years is fairly optimistic. To be blunt, I think particularly for an average income earner, you're not going to see the growth in the values that rapidly that you're going to be able to keep leveraging up every single year. It's just not going to happen. But you can, over the longer term journey, certainly build a portfolio of 3, 4, or 5 properties, and I think that's a substantial portfolio for anyone. And so I think and the whole goal of it, obviously, when you're buying the property and getting all yourself set up, there's a bit of work involved in that, and using experts helps minimize that work for you, but there's still a little bit of work. But then once you've got that investment property, you shouldn't have to think about it regularly. You go about your day-to-day life, enjoy your job, enjoy your life, enjoy the work that you're doing, or enjoy your family time. It shouldn't be to that point where it's a second full-time job. There's something wrong there. You're not using the right advisors, or you've bought some bad properties that shouldn't take up that much work.
Yeah, no, that's a good point. And it's all about, you want outcomes, you want a better future life, but you should enjoy life, work-life balance, and all these sort of things. So in moderation. Now, you've had roles on the Real Estate Institute, West Australia, and other positions. So you're probably in a pretty good position to give your views, because one of the things you did mention before is that we have negative gearing, and that comes up every election. What's your view? Is it here? Is it any chance that it could disappear, or what's your views on, or any other legislation that could affect property investment?
Oh, look, there's always talk about it. We know what happened in 2019 when Labor took it to the election. That and franking credits obviously were the two things that killed them in the anyone who was trying to get ahead in the world. They weren't very popular policies, and the people voted with their in the ballot box, and we know the outcome. Look, there's always a risk of it. Ultimately, it's here. It's been around for a long time, and you can negatively gear shares. It's not just property, but that's properties where it's obviously used the most. Is all the studies show in the Productivity Commission or Reserve Bank, it's not going to bring down property prices very much at all, maybe 3 to 4%. But what it will do is put rents up substantially, because at the moment Australians are willing to take a lower rental yield. The punting that they'll get capital growth, that the tax system helps them with that negative cash flow by giving them. Allowing them to claim the loss against their other income. So all I think it'll do is you'll see investors exit. You'll see prices adjust marginally, but you'll see rents rocket substantially. And all around the rest of the world, if you buy rental properties in the US, they have loss limitations. They're called passive loss limitations. We can't just negatively gear unendingly. There is a limit on how much you can have your passive losses. And many other countries around the world, you see the rents relative to the property prices are much higher. So if that's the sort of society that we're comfortable with, already seeing a lot of rent stress out there in the market right now. If you want to see rents 30% higher, well, that's probably going to be the outcome over a 5 or 10 year period. So look, I'm agnostic on it. I think ultimately the market will adjust. It shouldn't, if you're going to stop it, shouldn't just be on property. It should be should be stopped in totality. Why should one asset class be picked on over another? But all it would actually end up doing is having very little impact on the property market in terms of affordability, and push rents up significantly. And I think that'd be a dumb policy, but that's always a risk. And I think the one important thing though, Mark, is no one would ever, I don't think, in their right mind, and be a pretty brave politician to bring it in retrospectively. So what they would do, and what is, if you already got a property that's negatively geared, you're going to be almost certainly grandfathered in if they change the rules. So you wouldn't have to worry that all of a sudden overnight you're going to have to find extra cash because you can't get your tax deduction. So I think that's pretty safe. There's always a risk that the policy might change, but I think from a retrospectivity point of view, I just don't think that would happen.
Yeah, that's a really good point about the retrospective, because they keep talking about superannuation, all the rules could change, but they've never, and they will. the government can't help but tinker with superannuation, but they've never done anything retrospectively in 30 years. So I think that's the same really good point regarding property as well. Now, one of the things, and I should actually just comment, one of the things I do, I talk to groups of people, and they were mainly young people in this group I spoke to in the city, and there was an older chap, and I was saying, oh, well, rent's growing probably about 5%. He said, no rent's growing at 5% there. He absolutely got hailed down by everyone else in the room and saying, yeah, you obviously don't rent because rent is, even with the tax deduction, is on the increase. So it's something that, getting into property is so important, and getting someone else to help pay you that property off for you is also so important. So the future of property investment, we talked about the negative gearing. You mentioned before, so it's probably a good time to raise that about commercial property does, if you do this well, can get a better return over the long term than residential, and a low cost way of getting into commercial property is through funds. So do you want to just talk a bit about that? Because that's a lot of people don't realise that.
No, Mark, we've certainly seen as more and more people have certainly built wealth through superannuation. As we know, I think it's $3.5 trillion asset class now. It's huge. More and more people who are taking control of their wealth in self-managed funds, looking at investment alternatives. And the great thing about a self-managed fund, of course, is you can invest in a wide variety of asset classes that you can't do through a big super fund that's out there in the world. So we've certainly seen people looking for different options, and they're looking for income. Generally, as they get towards retirement, they're looking for that income stream, and commercial property is becoming very, very popular. And the good thing about what's available now in the market, what's a lot more common than it was 20 or 30 years ago, is the ability to invest via a fund. So there's two types. There is listed funds, so they're on the Australian Stock Exchange. You can buy them tomorrow, but they tend to be more volatile. The values of those assets rises and falls 30, 40%. And so it's for a lot of investors I speak to, they don't like that, because even though it's fundamentally investing in underlying property, the asset values don't always reflect that. And it's going up and down like the stock market. So a lot of people prefer the unlisted funds. And so what unlisted funds are is we are a fund manager who will buy a property or a pool of properties. And generally so they might buy, say, 30, 40, 50 or $100 million of assets, but then they syndicate that off. So simple example, if you in a fund that might buy an asset for 40 million, they might put in 50% debt for 20 million, so they raise 20 million capital. If you put in 200,000 into that fund, you own 1%. If you put in $20,000, you own 0.1% of that fund. But that means you would get exactly that proportion distribution. So whatever income stream comes in, they would pay that out to you. Most of them pay it out monthly. And also then in terms of capital growth, most of them, again, at the end of the fund period, if they sold that asset off, you would get the pro rata share. So a lot of people are liking that. And certainly that's one of the things we do at Westbridge, but people like it because they can go into their life. They've got a professional asset manager picking the asset, managing the asset, giving them the income returns. They don't have to deal with the tenancy. They don't have to deal with all the headaches of that. And they get exposure to much better quality assets. For $25,000, $30,000, you might get exposure to really some really great assets across the country, depending on which funds you're in. And that's certainly it's almost democratized commercial property investing. If you go back 30 years ago, it was really for the big super funds, the big life insurance companies, and the wealthy, the super wealthy who could afford to go and buy that sort of stuff on their own. Now, a lot more people have access to it, and it's becoming a very popular class. It's regulated by ASIC. You've got to have anyone issuing these products needs to hold a financial services license, and they put out disclosure documents, PDS, if it's a retail or information memorandum for wholesale investors. And I certainly think if it's someone looking for income in retirement, they don't have to deal with the headaches and hassles, and want a bit of diversification as well. Looking at commercial property funds is a good way to spread that risk around, get some diversification, get some income, and go and enjoy life.
And really good points there. And it's like anything, having a diversified portfolio, and exactly, your fund may be doing great guns and all that, but you look at a small portfolio, your small part of your portfolio to do that, to be diversified, and you'd never put 100% of your money in any one thing. But I just think it is really so important to consider these sort of things, because good commercial sized properties that you just couldn't afford yourself, here you get a chance to, so even if it's buying a small part of it, but you're getting the great benefit of the return of those investment properties. So no, that's really good. And thank you for explaining that, Damian. It's actually been brilliant. I love talking about property. As a financial advisor, there was a lot of things we only could talk about what we could, the products that we could promote. But I just thought, I saw so many clients who just said, but I also want to talk about property. I want to see can you help me get into my first property? And so, especially the last 10 years, I took a really great interest because my clients were wanting this, and it just makes so much sense. I can't sell a property, but at least I can talk about those strategies with my clients. I put it in my book, but I absolutely encourage people to look out for your book. I'll just definitely, it's called their Property Investing Roadmap. It was launched yesterday, so Damian, really well done on that, because I know how tough it is to get out a book. I'm sure it's going to help a lot of people. But one of the final things I always ask my guest is there a piece of advice that you've heard or that you live by, that you've just heard, that, financial or in life, that you could share with our listeners now?
Mark, I'm very big on buying and holding. One of the things that I learnt when I first started in property, I used to be an accountant, and by background, I got out of that full time and was in property and was buying and investing in properties, developing, but I was selling everything. And so that was always thought, that was what I thought, oh, to make a profit, you've got to sell, you've got to take your profits. And then it took me about 5 years, took me a bit of time to wise up, realised, well, hold on, I'm paying real estate agents, I'm paying the tax, a capital gains tax or income tax on developments because it was income. Then I'm paying stamp duty when I get back in again. I looked at all the profits that I'd given away to those three transactional costs and going, why am I doing this? Why am I holding it? And, Warren Buffett's obviously one of the most successful investors in the world. And, it's the same in the stock market, people trading in and out, but he's been hugely successful by buying great assets, holding on to them for the long term. And I think fundamentally the same as in property. If you buy a great asset, don't worry, get caught up in the hype of what's the market doing next week, what's it going to do next year. Hold for the long term, and if you do it well, you'll make substantial amounts of money to set yourself up for life.
Brilliant. Long-term investing is always the most successful way, and won't give you ulcers as well. Damian, it's been a real pleasure to have you on the show. Best of luck with the book, and links to the book and everything like that will be put on the website, on the podcast website, so look out for that. But again, just thank you very much for being on the show.
Thanks, Mark. Great to be here.
I hope you enjoyed this episode. If you'd like to know more about Damian or want to buy his book, Property Investing Roadmap, visit www.damiancollins.com.au. That's DAMIANCOLLINS.com.au. Or feel free to email me on admin@themoneysandwich.com, or visit our website, themoneysandwich.com, if you have any questions or would like to learn more. Want more practical, easy to understand tips and action lists to help with your money stuff? The latest version of my book, The Money Sandwich, is now available to order on Booktopia and Amazon, as well as available at all popular bookstores. Everyone deserves to retire comfortably and on their own terms. Make this the year you take action. As with every podcast, this information is not advice, as not personalised to your own situation. And past performance is never guaranteed for the future. What we are trying to do here is to provide tips, coaching and education to help improve your money knowledge, which we believe can only be a good thing. See you next time when we take another bite from the Money Sandwich.